What do you make of all this weakness in the pre-market? We saw weakness after that better than expected jobs report. We saw bond yields spike. Is that simply just continuing over into Monday, or do you think something else is at play?
Well, I think it's very important it is continuing and it feels a little bit rough, but I think the important point of what you just said about bond yields is that long-term interest rates actually did not spike. The 30-year bond was trading about 4.93%. It spiked to 5%. It's all the way back to 4.95. It's almost unchanged from where it was pre-payrolls. What's moving is the front end. We've seen a significant 10 to 15 basis point move in front end yields. People are getting nervous that the Fed is going to have to stay much higher for much longer, and that's actually not going to be the right signal for the Fed. So the interesting thing about what the price action said to me on Friday and is continuing today into Monday is, even though we saw this unbelievable strength in the U.S. economy and people are quite optimistic about that strength going forward, they're getting increasingly worried that the Fed's going to have to make a bit of a mistake keeping rates too high for too long, and they're getting very nervous about what that might do to long-term prospects for growth.
Should we be getting nervous about the rise in the dollar as well? I'm looking at the chart over the last week. It did spike on Friday after the jobs report, but up 1.5% over a week. Again, a huge move for currency over that period of time. We talk a lot about the concentration in the market. These big tech stocks, they get a lot of their revenues overseas. Do you think that just the strength of the dollar would hit their earnings, which would then hit the market? Is that something that isn't even priced into the market? Is that something that you're watching?
Watching the dollar very closely, and that's very tied into these short-term yields. The dollar is going to key off of short-term rate differentials, and for sure, the markets are going to get nervous about that ever strengthening dollar. That is putting us in a less competitive position in the United States, and that is making it harder to do business with that competition. So that's going to weigh on every stock, not just the tech stocks, but pretty much anybody that looks at a valuation globally is saying, wow, these stocks look even more overvalued relative to their competitors overseas. And that's going to be a tricky thing to deal with. But that is also a sign that it's not inflation expectations or credibility or some story that the U.S. is losing control of the policy vis-a-vis inflation. If that was the case, people wouldn't be flocking to the dollar. People wouldn't be treating the long bond as well as they are. This is not an inflation story. It's a story that the Fed is getting, I don't want to say tricked, but almost forced into staying a little too high, a little too long, because they're getting mixed signals from the market. And there's also a potential for a little battle between the Trump administration and Jay Powell, as we saw before in the Trump 1.0.
David, we don't want to get ahead of ourselves with that, though. We don't want to get too far ahead of us. Let's focus on the action today, if you don't mind. Speaking of, I want to get your word of the day. What word do you think kind of gives an indication of what we should expect today or this week?
Well, I think the word of the day is the University of Michigan, or UMich as we call it. I think that piece of data got very much under the skin of the market on Friday. It was a huge spike in the long run expectations from, I think, 2.8% to 3.3%. It's generally revised down when we see a spike like that, but I think that's got the market very nervous. But we're not seeing that in the price action. We're seeing that as a scare. We're not seeing that in price action, meaning people don't think inflation expectations are really doing that. They're seeing that as a reason why the Fed's going to kind of be a little more stubborn in terms of its rate moves in 2025. And that's just got people pricing in a mistake even more aggressively. And I think that's how I'm going with it. But that piece of data, to me, is the word of the day. The thing that got the market rattled were those expectations.